welcome back. You're watching The Money Show with me, Kavita Thaplial, and there are plethora of funds available in the market to invest your hard-earned money in. But how do you assess which is the right fund for you and for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have Nisreen Mamaji, CFP, Moneyworks Financial Services. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Hi, good evening, Nisreen, and welcome to the show. And let's begin our Q&A. First viewer is Shawnee, and she sent her question via email. She says that she's been investing 10,000 in mutual funds via SIP, and the funds that she has in the portfolio are SBI Small Cap, UTI Nifty 50 Index, HDFC Flexi Cap. She wants to know if these funds are good enough to continue investing for next 15 years.
So basically, she's reviewed her portfolio and all the funds seem to be above par. So she's got SBI Small Cap, she's got UTI Nifty 50 Index and HDFC Flexi Cap. And the returns for 2 years have been on par as well as for 5 years and 10 years. Now, if she continues investing at the tax of about 15%, she will be returning about 68 lakhs at the end of 15 years. So if that's a query, she can continue with all the three funds. They are performing well in their category and they are on par.
So the thing over here is for 15 years, you think she needs to plan better, and maybe we really don't have a lot of information. We don't know what is her goal for which she wants to accumulate, what kind of a corpus. But then to start off with, are these funds or this is an ideal portfolio?
So, typically if this is the amount that you are saving and you are not going to need anything for the next 15 years. So otherwise, you have to plan for shorter term goals or emergencies. So for an emergency purpose, it would be better to be parking some money, at least about 10% of your portfolio, into a category called equity savings, okay, which is good for about 12 to 15 months. You should select an equity savings fund which has about 15% of equity exposure and 85% in bonds, so that if you need the money in the shorter term, it will be available to you without volatility of 100% equity fund. For the medium-term goal, you can select a large and a mid-cap category or a flexi category, which would be your goal for, say, between 2 to 5 years. Hello.
Nisreen, we heard you over there. Okay, let's move on to our next question. I think I have Anjali on the phone line with me. Okay, I don't have her, but then she says that she started her first job recently, and she wants to start investing 5,000 in mutual funds every month for next 10 years, and she wants to understand the funds that you might want to recommend.
That's Anjali, right?
Anjali, right?
Yeah. So Anjali, if you don't have any shorter term requirements, and 5,000 rupees is what you're going to invest for the longer term that you've mentioned about 10 years. So in that case, you can select 2,500 rupees each in a multi-cap strategy and in a small cap strategy. The funds we've recommended are Nippon India Small Cap Fund and Mahindra Manulife Multi-Cap Fund. Now, again, I would like to put a disclaimer here and say, you are not going to need this 5,000 rupees SIP for the next 10 years. If you are, then you also have to plan a little more liquid category, which could be a balanced advantage category or an equity savings category, where you could put a small amount even in that option. So out of 5,000, maybe you can put, say, 1,000 rupees in a fund which you can, use in the shorter term also. If you are confident of not needing this amount for the next 10 years as you specified, then you can confidently go into 2,000 rupee, 2,500 rupee multi-cap and 2,500 rupee mid-cap strategy, Nippon India Small Cap and Mahindra Manulife Multi-Cap. So you can interchange the mid and the small fairly decently.
Interesting, Nisreen, people are thinking of starting their investment right from their first job and the first salary that they get. But it's also important for them to start aligning their goals. Maybe right now they might just want to look at it as wealth creation, but then how can you align your goals when starting so early?
So, when you're starting early, a small percentage of your investable surplus, you should also think a little long term and plan for retirement. So that's the guidance that I think that we need to also tell, because we don't have a 401k in our country like the Americans do. So this kind of planning for the longer term, planning for at least the next 25 to 30 years should be encouraged right from your first paycheck. So at least, 30% of your investable surplus should be towards your longer term goals. And 50 to 60% can be for the medium or short term goals because as Kavita rightly said, we don't know when we will need the money, even in the shorter time frame. And then you have a very dissatisfactory customer experience because the money is locked away for the longer term and it's not liquid when you need it. For that category, there's something called a dynamic asset allocation category where we have, the equity savings funds, the balance advantage categories, and also even for the very, very short term, we have something called an arbitrage fund or a money market or low duration fund, which is something that you can consider from 0 to 12 months. So for that is the money which is an alternative to your savings account where you can take it at will. For an arbitrage fund, you get the money back in 2 days. And for a money market fund, you can get back the money only in 1 day. So these are the little changes that you can make to your portfolio. Rather than leave it idle in a savings account, you can put it to work in an arbitrage fund or in a money market or a low duration fund where you can expect a little alpha over your savings account. Okay, so that's the kind of investment that you can use for say 1 to 3 year bucket of priorities. For 3 to 5 years, you can use something called a large and mid cap fund where the money is in 100% equity, but at the same time does not have the volatility of a small and mid-cap portfolio. And what you're planning for your retirement should ideally be in a multi-cap or in a mid-cap portfolio, which you hopefully won't touch it at least for the next 10 to 15 years.
Right. Let's move on to our next question. And next question is from Ritika. Nisreen, she says that she wants to invest 2,000 per month for next 10 years with the aim of collecting the corpus of 50 lakh. And this is a travel fund that she wants to create for herself. And again, she wants some fund suggestions. So this is a very interesting question also because there's a goal lined up. And in fact, in the first question only, I wanted to ask you that it's nice that these investors are thinking of long term and, want to have a long term strategy for their long term financial goals. But then they also have some aspirations. They also have some dreams which they want to fulfill by investment portfolio. Like Ritika, she wants to travel. We don't have her on the phone line, otherwise we could have asked her if 50 lakh is what she's really looking at and what's the time horizon, after which she might want to travel a lot. But then given the fact that you can align your goals, you can plan them, you can start investing for them, be it short, medium or long term, is the beauty of this entire strategy that one might want to adopt.
Sure. So typically, rather than working on a 50 lakh portfolio for travel, I think I'd also like to give a little advice right now is to figure out where you are going. Where is your first holiday? So, you won't be going for an international holiday right in the beginning of your earning career. You might start with a smaller holiday, maybe in India, maybe driving distance from the city that you live in. So, your transport cost will be a little bit lower. Also, where you plan to stay and how you plan to do your sightseeing. A little bit of budgeting now can really help you to start your travel goal immediately. Because 50 lakhs is, frankly speaking, a very large amount of money, which you may not use, the entire amount for travel. Because, I'm assuming that you want to have this corpus and then you want to travel every year to exotic destinations. Rather than that, what you should be looking at is looking at, travel destinations which are closer to you, looking at cheaper options of stay and travel and sightseeing so that you can start your travel journey very comfortably with lower amounts, because at this point you are planning to save about 2,000 rupees. So, you should be also a little realistic in terms of, where and what you can achieve in that much, because the, mutual funds and the investment options will be shorter term, medium term and longer term. For the longer term buckets, you can be invested in a mid-cap portfolio, in a small-cap portfolio, in a multi-cap portfolio. But that will be setting you back by many years. So in the midterm, which is say between 1 to 3 years or, say 2 to 5 years, that would be, we would consider that a midterm kind of a scenario. where you can be looking at an investment in a balanced advantage category or in an equity savings category or in a large cap category of, mutual fund, which will help you to serve your goal. But at this point of time, if you are asking me, I'm investing 2,000 rupees, when will I reach my, goal of 50 lakh rupees, or the other way around, I have about 10 years to invest. How much money do I need to reach 50 lakhs? So my answer would be you need about, I think 45,000 rupees in SIP in order to reach that goal of 50 lakh rupees, because the goal is only that high. So realign the goal, realign the investable amount, and you are sure to meet your travel plan quite successfully.
Advice for Ritika. We move on to our next query, which is from Rahul, again an email, and Rahul says that he has Parag Parikh Flexi Cap in his portfolio. Nisreen, he has SBI Mid Cap and Axis Small Cap, and Canara Robeco Small Cap Fund also, 4,000 rupees each in all these funds, and he wants to do this SIP for 25 years, and 10% step up is also what he's thinking. Currently, he's 33 years old, and he wants you to review his fund mix. So, as per his age, I think funds are really good, but then a little more towards small cap.
Yeah, so he is skewed towards small cap. I think possibly because he's looking at the 27-year investment horizon. Okay, so there again, I would like to just advise him to, because you never know when you need money. You need money for emergency funds. You'll also have shorter-term goals. So if this is the funds that you're keeping aside only for the, extended period, which is 27 years away, I do understand. But it's for all, caution, you should be investing at least 30% to 40% of your portfolio for the shorter-term investment option. So as I said, as I advised somebody else earlier, in the 0 to 1 year segment, you can look at arbitrage funds or money market and low duration funds. From the 1 to 3 year segment, you can look at balanced advantage category. If your risk profile is slightly higher, that means you have a slight more comfort of funds availability, you can look at the large and mid category and the flexi cap category. And for any goal which is 5 years upwards, where you know confidently that you're not going to need the resources, so that could be, say, 30% of your portfolio. You can put it away for, in a small cap skewed portfolio, which you are doing currently. So do have a look, at the portfolio. It is a very good portfolio. It's a longer term portfolio. So when you're going with a small cap like this and a flexi cap, you are going to be committed for a longer period of time. But, the way things go, sometimes we do need the funds before our expectations. You will have some sort of emergency. You will have some sort of requirement in the shorter term. And at that point of time, if the money is illiquid, if the market has corrected and you're not able to withdraw even your principal amount, you will have a very unsatisfactory customer experience and you will feel, okay, mutual funds are not for me. So to avoid that, keep buckets of investable surpluses for the shorter term, like 0 to 3 years, 3 to 5 years, and then 5 years upwards. So you can make a small change in your portfolio in order to avail this liquidity and give you that flexibility even in the 0 to 5 years category. Okay? If you're investing for this amount and you've managed to get a 15% compounded annualized growth rate for the entire term, you will have a healthy corpus of 9 crores and 75 lakhs. Based on what you have said, that you are investing 16,000 per month, but every year you are going to step it up by 10%, which is also a very, very smart thing to do, because we rarely, increase our SIPs. We don't top up our SIPs every year. When you start a figure, then you just continue for 5-6 years without thinking that annually your income is also going to go up. And therefore, with that increase of 10% annually, you are going to spend it if you don't invest it. So do remember that today's savings are tomorrow's spending. And when you are retired, you're going to spend your money. But of course, because you have taken advantage of this step up, which I heartily congratulate you. It's a very, very smart thing that you've done. And, so the step up is very important every year. We must take into account that, hopefully our incomes will be going up marginally by between 5 to 10%. And that extra salary should be immediately put to use in your SIPs and not left idle, forgotten or spent.
Let's move Move on to our next question, Nisreen. It's from Bhaskar, and he wants to know the right time to redeem Tata Digital India Fund. So before we give him the answer, I want you to help our viewers understand what kind of a fund is this and what kind of a sector it follows. What's the fund exposure like?
Sure. So the Tata Digital Fund basically is a fund which is, concentrates on technology, on communication, on services, on capital goods, financial sectors. And the main thing is that because it's digital, and right now the three main sectors which are poised to do very well, it's a sectoral fund, I must give you that. So it's a higher risk fund because, the stocks that will be selected here, like for example, the top five stocks are Tata Consultancy Services, Tech Mahindra, LC, iMindtree, HCL Technologies, Infosys. So these are the stocks which are the top five in this particular fund. So definitely it is a sectoral fund and therefore it is a higher risky kind of a investment option. So since you have clearly taken it, please stay invested because the next 5 years we definitely expect consumer, IT, and financials to do very well. So please continue with this investment. Do not redeem it now. You will miss out, on some discovery and some valuations if you redeem it too early. So, having said that, typically we do not suggest our investors to go into sectoral funds unless it is 5 to 10% of your portfolio. So if you have other funds, then it is absolutely okay to restrict any sector, whether it is pharmaceuticals, whether it is infra, whether it is digital or IT, to about 5 to 10% of your portfolio, but it can't compose your entire portfolio. But now that you have invested, please stay invested because you will certainly make some funds here. But you have, as of now, you should stay invested.
Stay invested. That's the word for you. Manish has sent this question by email. He's 42 years old and he has a goal of 5 crores in 18 years. And that's his retirement corpus that he's planned. And he wants to understand what should be his SIP amount and in what kind of funds that can actually get him this 5 crores of corpus after 18 years. So, ideal SIP amount would be, Nisreen?
So his SIP amount should be about 45,000 to, around 45,000 rupees for 18 years, provided that we have managed to get a compounded annualized growth rate of 15%. Okay? Since he is looking at a slightly longer term, we can safely say that, we normally predict about 12% for a large cap fund. For a multi-cap fund, we, project at the rate of about 30%. And for a small and mid-cap fund, we kind of project at the rate of about 14 to 15%. So having said that, one always has to err on the side of caution. And so we will just take a round figure of about, between 12% to 15%. So his SIP at 15% is about 45,000 rupees. And at 12%, it will be slightly higher, around 52,000.
All right. Could you also explain the kind of funds he should have in his portfolio?
So, 18 years, you can look for a multi-cap strategy and a mid-cap strategy for about 50 to 60% of the portfolio. And for the balance 40%, you can go for a large cap strategy or a large and mid or a flexi cap category. 10% of the portfolio should be for your immediate liquidity return, which can be either a 100% debt option or it can be an arbitrage fund or an equity savings category. So do not forget to keep about 10% of your portfolio in a slightly liquid option, which is equity savings, balance advantage category. And to be even more safer, you can be in a low duration fund or an ultra short debt fund. Both of these are in the debt category. So 10% in the shorter term bucket, about 30% in a large mid or a flexi, and the balance 50% could be in for the longer term, which is your retirement goal. And it's that you can aim towards keeping either mid, small or multi and thematic. Do a combination of these for the longer term.
Years is a very long time actually. How often should one be reviewing their portfolio?
So typically, Kavita, we review every year, but we make changes every 3 years. Because to churn the portfolio on an annual basis, you will get nowhere. Also, you're not giving the fund manager enough time for performance, especially if you're in a value category or if you're in a small and mid category, which requires time to perform. So the handholding is very important because, investors do get a bit anxious in the 6 months or 1 year stage when they have not seen returns or they are seeing some performance decline, even their principal amount is not, visible. So therefore, the education of the investor is very crucial because there is this beautiful, opportunity called a mid and small category. But for that, you have to be disciplined, you have to walk the talk, and you have to stay invested. So both the advisor, distributor, stroke planner, as well as the investor has to go hand in hand during this journey to make sure that the investor doesn't lose faith earlier. Because if you see a decline in your statement and you see some red, then you feel that I just want to get out of it. But actually, the silver lining could be just 6 months away or 1 year away. So the idea is, for you to build up your resilience and also to stay invested even in the bad times. So, for example, if there is a correction, that means there's a sale. Okay, now what do you do in a normal sale when you want to buy clothes or you want to buy shoes? You go out and buy in the sale. So the same thing happens when there is an opportunity. You have to purchase a little more than your usual SIP and also make sure that the rupee cost averaging works for you. In layman terms, it means when the units are priced low, you're going to purchase more units.
Right.
You should buy more when there's a sale going on. And when the price is down, don't get disheartened because every time the prices go down, it will also, the NAVs will go up at a certain stage.
Exactly.
Okay? So just stay invested, have the patience, and create a portfolio which works for you personally by keeping some liquidity in hand even for the shorter term.
Very important. On that note, it's a wrap today. Thank you so much, Nisreen, for being on the show and helping our viewers with their financial portfolio strategies. And I'm going to leave our viewers with our WhatsApp number and email ID where they can send us their portfolio-related queries and we'll get them answered by our experts. Thank you so much for watching. Goodbye.